What I'm about to show you is something that has not happened in the history of the silver market. And I'm not using hyperbole. I'm not exaggerating to get your attention. I'm telling you what the data is showing right now in real time as retail traders across America are doing something that's making Wall Street sit up and pay attention. Because what just happened in the silver ETF market isn't just notable, it's record-breaking, it's unprecedented, and it tells you everything you need to know about where sentiment is heading and what might be coming next. I'm recording this on January 27th, 2026, as silver continues its powerful rally. The price is trading around $112.50 per ounce. It's extending a 4-day winning streak. It's up nearly 4% just on this session alone. And behind the scenes, the flows into silver are reaching levels that are making analysts scramble to update their models. Now, before I go any further, I want you to do something for me. Drop a comment with the exact date and time you're watching this video. I am genuinely curious who's catching this in real time and who is finding it weeks or months later, wondering how they missed what was happening. And while you're at it, if you watch these breakdowns regularly and you haven't subscribed yet, just take 1 second and hit that button. It's free. It helps the channel grow. And it makes sure you don't miss the next update when things move fast. Because in a market like this, things are moving very fast. Now let me give you a cliffhanger before I walk you through the full picture. What if I told you that retail traders just poured $171 million into a single silver ETF in one day? What if I told you that's nearly double the peak from the famous 2021 silver squeeze? And what if I told you the trading intensity in silver is now outpacing Nvidia, the AI darling that everyone thought was the hottest trade on Wall Street? Hold that thought, because I'm going to show you exactly what's happening and why it matters more than you might realize. Let's start with the numbers, because the numbers are what make this story so striking. Vonda Research, one of the most respected analytics firms tracking retail trading behavior, just released data that should be on the front page of every financial publication. On Monday, individual investors net bought approximately $171 million worth of iShares Silver Trust. That's the SLV ticker, one of the most popular ways for retail traders to get exposure to silver without holding physical metal. $171 million in a single day from retail traders alone. To put that in perspective, during the 2021 silver squeeze, when Reddit investors banded together to try to squeeze silver alongside GameStop, the one-day peak was $93 million. That was considered extraordinary at the time. It made headlines. It sparked debates about market manipulation and retail power and the future of investing. What just happened is nearly double that, nearly double the 2021 peak. And it's happening without the same coordinated social media campaign. It's happening organically. It's happening because people are scared, because people are looking for safety, because people are watching the news and deciding they want to own something real. Now, here's the part that should really get your attention. Ashwin Bakri, the head of product at Vonda Research, said something that I think captures the magnitude of what we're seeing. He said the chase in silver is now more intense than the classic AI trade. Let me repeat that. More intense than the AI trade. The trade that defined 2024 and 2025. The trade that made Nvidia a household name. The trade that everyone thought was the future of markets. Silver is now outpacing that. The turnover in iShares Silver Trust is running at more than 11 times its usual pace. 11 times. For comparison, Nvidia's turnover increase during its hottest periods was roughly 7-fold. 7 times normal. Silver is at 11. The retail frenzy for precious metals has officially surpassed the retail frenzy for artificial intelligence. Now let me pay off part of that cliffhanger by showing you what this means in the broader context of market activity. Combined retail and institutional interest has driven volume in iShares Silver Trust to several times that of the SPDR S&P 500 ETF Trust. That's the SPY ticker, the most widely traded ETF in the world. The thing that tracks the entire S&P 500, the benchmark for American equity markets. Silver is trading at higher volume than that, not comparable volume, higher volume. A precious metal is seeing more trading activity than the entire US stock market index. If that doesn't tell you something fundamental has shifted in investor psychology, I don't know what will. Now, here's another cliffhanger. Not everyone is betting on silver going higher. Some traders are wagering big money that this rally is about to collapse, and the size of those bets is significant. I'm going to show you what the bears are doing and why it matters for what happens next. But first, let me walk you through why this rally is happening. Because understanding the drivers is essential to understanding whether this can continue or whether it is about to reverse. The rally is unfolding against a backdrop of rising uncertainty in Washington. And I mean genuine uncertainty, the kind that makes institutional investors reduce risk exposure and look for safe havens. Senate Democratic leader Chuck Schumer has confirmed opposition to a funding package that includes Department of Homeland Security appropriations. What that means in plain English is we're heading toward a potential government shutdown, The deadline is approaching. The political parties are not aligned, and the market is responding. Now, you might think a government shutdown is no big deal. We've had them before. The government comes back, life goes on, and that's true in the long run. But in the short run, shutdowns create uncertainty. They create headlines. They create the kind of environment where investors trim risk and look for places to park capital that feel safe. Silver and gold are benefiting directly from this dynamic. When investors don't know what's going to happen in Washington, they don't pile into stocks. They don't chase risk. They move to assets that have held value through every political crisis in history. And precious metals are at the top of that list. But the political risk isn't just about the shutdown. There's something bigger happening that the market is paying very close attention to. The Federal Reserve is meeting right now, January 27th and 28th. This is one of the most anticipated Fed meetings in recent memory. Not because anyone expects them to cut rates tomorrow. The consensus is that they'll hold rates steady. But because the forward guidance, the language, the tone, and especially Chair Jerome Powell's press conference could shift expectations about what happens next. And here's the thing, expectations are already shifting. Investors are increasingly betting that rate cuts could accelerate later in the year. That expectation has been weighing on the US dollar. And a weaker dollar is like rocket fuel for precious metals priced in dollars. Think about the mechanics. When the dollar weakens, it takes more dollars to buy the same amount of silver. But it also means that silver becomes cheaper for international buyers. They can buy more with their currencies. That stimulates demand, and that demand pushes prices higher. Silver is also a non-yielding asset. It doesn't pay interest. It doesn't pay dividends. In a high interest rate environment, that's a disadvantage. Why hold silver when you can earn 5% in a money market fund? But when rates are expected to fall, when real rates are expected to stay subdued, that disadvantage disappears, and silver starts looking attractive again. That's the monetary policy backdrop. It's supportive, and it's getting more supportive as rate cut expectations build. Now let me add another layer to this, because the political and monetary factors aren't the only things driving this rally. Trade rhetoric has exploded in the last few days, and the headlines are the kind that make global investors nervous. President Trump recently warned that tariffs on South Korean imports could rise to 25% from the current 15%. He cited delays in trade negotiations. He's putting pressure on Seoul to move faster on a deal, and the market is taking notice, but it doesn't stop there. Trump also threatened 100% tariffs on Canadian goods if Ottawa pursues closer trade ties with Beijing. 100%. That's not a negotiating tactic. That's an economic ultimatum, and it's reviving fears of escalating protectionism that many investors thought had calmed down. When trade tensions rise, supply chains get disrupted, costs go up, economic growth gets threatened, and investors start looking for hard assets that exist outside the chaos of trade policy. Gold and silver have been that refuge for centuries, and they're playing that role again right now. Zain Vauda, an analyst at Market Pulse by Owanda, made an important observation. He said persistent tariff uncertainty is unlikely to fade quickly. That means the demand for precious metals as a hedge against headline risk is likely to remain elevated. This isn't a one-day story. This is an ongoing backdrop that could support prices for weeks or months. Now, let me give you another cliffhanger. What's happening in the physical market is even more intense than what's happening in the paper market. The premiums being paid in Shanghai are signaling something that could change everything. Hold that thought. Let's talk about the physical market, because this is where the real story gets interesting. Silver prices had tripled in the past year. We're now exceeding $100 an ounce, and that move has been driven by a mix of factors. Retail speculation, momentum-driven buying, but also persistent shortages in physical supply. UBS analyst Giovanni Staunovo highlighted something critical. Chinese silver prices are trading at a premium to London. Not a small premium, a significant premium. That's a sign of regional demand stress. It tells you that buyers in China are willing to pay more than global spot prices just to get their hands on metal. According to Saxo Bank, Shanghai premiums are exceeding $14 per ounce above London prices. $14? On a metal trading around $112, that's a premium of more than 12%. That's not normal. That's supply tightness. That's the market screaming that there isn't enough metal to go around. And here's the dynamic that's making this even more intense. COMEX futures and silver-backed ETFs have been net sellers in recent weeks. That sounds bearish, right? If the big paper markets are selling, shouldn't prices go down? But what's actually happening is a shift in demand. The demand is moving from paper to physical. Buyers want bars and coins. They want metal they can hold. And that physical demand is overwhelming the available supply. This is particularly acute in Asia. Chinese buyers, Indian buyers, retail investors who have watched silver triple and want to own the real thing. They're not buying ETF shares. They're buying physical metal. And The physical market is much smaller and much tighter than the paper market. Now here's the liquidity risk that's coming, and I want you to be aware of it. China is approaching the Spring Festival holiday. The Shanghai Futures Exchange will close from February 15th to February 23rd. There will be no continuous trading on February 13th. That's a significant chunk of time when one of the world's largest silver markets will be dark. What does that mean for prices? It means liquidity could thin dramatically in the weeks ahead. And when liquidity thins, volatility increases. Prices can move more on smaller volumes. Gaps can appear, and the kind of orderly trading that normally characterizes major markets can give way to chaotic swings. If you're holding silver or thinking about buying, you need to be aware of this calendar effect. The holiday period could exacerbate price swings in both directions. It could be an opportunity. It could be a trap. It depends on how you're positioned and how much volatility you can stomach. Now let me pay off that cliffhanger about the bears, because not everyone is betting on this rally continuing. Vanda Research noted something interesting. The ProShares Ultra Short Silver ETF, which trades under the ticker ZSL, saw trading activity about 4 times higher than usual. This is an inverse ETF. It tracks twice the inverse of a silver index. That means it goes up when silver goes down, and it goes up twice as fast. Strong retail interest in ZSL tells you that some traders are betting big that silver prices will fall. They're looking at this parabolic move and concluding it can't last. They're positioning for a reversal. They're willing to bet money that the rally is about to end. Now who's right? The bulls pouring money into SLV or the bears betting on ZSL? I don't know. Nobody knows. But what I can tell you is that when you have this much conviction on both sides, when you have record flows into the long ETF and quadruple normal flows into the short ETF, you're setting up for a violent resolution. One side is going to be right. One side is going to get crushed. And the move, when it comes, is likely to be fast and brutal. That's the nature of crowded trades. When everyone is positioned in one direction and the market reverses, the rush for the exits creates cascading selling. And when everyone is positioned for a reversal and the rally continues, the short squeeze creates cascading buying. We're in that kind of environment right now. Maximum uncertainty, maximum conviction, maximum potential for volatility. Now let me talk about the mining stocks, because the retail frenzy isn't limited to silver ETFs. According to Vanda Research, Pecla Mining and Cure Mining have made their way into the top 50 most actively traded names in the market. Think about that. These are silver mining companies. They're not mega cap tech stocks. They're not AI darlings. They're old school miners that most retail investors had never heard of a year ago, and now they're in the top 50. That tells you the frenzy has spilled over. People aren't just buying silver exposure through ETFs. They're buying the companies that dig it out of the ground. They're looking for leverage. They're looking for upside. They're betting that if silver keeps running, the miners will run even faster. And they might be right. Mining stocks offer leveraged exposure to metal prices. When silver goes up, mining revenues go up. But costs are relatively fixed, at least in the short term. That means margins expand, earnings grow, and stock prices can move multiples of what the underlying metal moves. But mining stocks also carry risks that physical silver doesn't. They have execution risk, they have management risk, they have jurisdiction risk, they have cost inflation risk. Not every miner is a winner just because silver is going up. Some of them will disappoint. Some of them will dilute shareholders. Some of them will miss production targets. So if you're thinking about playing this rally through mining stocks, do your homework. Don't just buy anything with silver in the name. Look at the balance sheets. Look at the production profiles. Look at where the assets are located. The sector is getting attention, which means it's also going to attract garbage. Don't be the one holding garbage when the music stops. Now let me connect all of this to what traders are watching next, because the calendar matters. All attention is now on the Fed's policy statement coming on January 28th. That's tomorrow as I'm recording this. Chair Powell's press conference will follow, and every word will be scrutinized. What's the market looking for? Any shift in tone on inflation? Any hint about the trajectory of rates? Any signal about leadership succession at the Fed? Any suggestion that political pressure is influencing monetary policy? Any of these could trigger sharp moves across currencies and metals. If Powell sounds dovish, if he hints that rate cuts are coming sooner or will be deeper than expected, that's bullish for silver. It weakens the dollar. It reduces the opportunity cost of holding non-yielding assets. It supports the rally. If Powell sounds hawkish, if he pushes back against rate cut expectations, if he emphasizes that inflation isn't dead yet, that could trigger a reversal. The dollar could strengthen, bond yields could rise, and silver could give back some of its recent gains. The uncertainty is maximum right now, and that uncertainty is itself supporting prices. Because when you don't know what's coming, you hedge, and precious metals are the ultimate hedge. Now let me give you a practical framework for thinking about all of this, because I don't want this to stay theoretical. Silver's rally appears increasingly stretched. Everyone can see that. A move from around $40 to over $112 in a year is extraordinary. The chart looks parabolic, the flows look frenzied, The sentiment looks euphoric, and parabolic moves don't end gently. They end with reversals that are just as violent as the rallies that preceded them. That's history. That's the nature of momentum-driven markets. But here's the other side of that coin. Stretched rallies can stay stretched. Overbought markets can get more overbought. And the conditions driving this move, political uncertainty, monetary policy shifts, trade tensions, physical supply tightness, none of those conditions have resolved. They're all still in play. So what do? If you're already holding silver, you need to have a plan. Know what would cause you to take some profits. Know what would cause you to add more. Know what would cause you to exit entirely. Don't make those decisions in the heat of the moment. Make them now when you can think clearly. Write them down and stick to them when the volatility tests you. If you're thinking about buying now, you need to understand the risk reward has changed. You're not buying at the bottom. You're buying after a tripling in price. That doesn't mean there isn't upside. The fundamentals are supportive. The flows are enormous. The physical market is tight, but the risk of a sharp pullback is higher now than it was at lower prices. Size your position accordingly. Don't bet more than you can afford to lose. If you're on the sidelines waiting for a pullback, you might get one. But you might also watch the rally continue without you. The decision to wait is itself a decision. It has consequences. Just make sure you're making that decision consciously, not out of fear or paralysis. Now let me address the dual nature of silver, because this is something that does not get enough attention. Silver isn't just a precious metal, it's also an industrial metal. It has real demand from sectors like electronics and solar manufacturing. That dual nature is usually a strength. It means silver has fundamental demand beyond just investment flows. But right now, it might be a risk. UBS analyst Giovanni Stanovo cautioned that sustained high prices could begin to curb industrial consumption. Think about it. If you're a solar panel manufacturer and silver has tripled in price, you have a problem. Your costs have exploded. Your margins are getting squeezed. You start looking for ways to use less silver. You start looking for substitutes. You start deferring purchases. That demand destruction doesn't happen overnight. Industrial supply chains are sticky. Contracts are locked in. Alternatives take time to develop. But if prices stay elevated for long enough, the industrial demand that supports silver starts to erode. That's the tension at the heart of this market. The investment demand is surging, but the investment demand could price out the industrial demand. And if the investment demand ever fades, the industrial demand might not be there to catch the falling price. I'm not saying this will happen. I'm saying it's a risk you need to be aware of. The higher prices go, the more this risk grows. Now let me talk about what happens if this rally continues, because the upside scenarios are what's drawing people in. Silver hit a record intraday high of $117.69 on Monday. That was the peak before some profit-taking pulled prices back. Now we're around $112.50. The question everyone is asking is whether we take out that high and keep going. If we do, if silver breaks above 118 and starts accelerating, you could see a blow-off top scenario. That's when prices go parabolic, not just on the chart, but in the minds of investors. Headlines multiply. FOMO intensifies. People who swore they'd never buy silver start buying. And the late money provides exit liquidity for the early money. Blow-off tops are exciting to ride and devastating to hold through. The gains can be spectacular, but the reversals can wipe out months of profits in days or hours. If you're trying to catch a blow-off top, you need to be nimble. You need to be ready to sell into strength. You need to accept that you'll probably leave money on the table, because nobody rings a bell at the top. Now let me talk about what happens if this rally fails, because that scenario is equally possible. The bears betting on ZSL are expecting exactly that. They're looking at the stretched chart, the euphoric sentiment, the record flows, and concluding it can't last. And they might be right. If the Fed surprises with hawkish language, if the dollar strengthens, if bond yields spike, if the shutdown is avoided, if trade tensions ease, any of these could trigger profit-taking. And once profit-taking starts in a crowded trade, it can cascade. A move back below $100 would be technically significant. It would break the psychology. It would turn recent buyers into bag holders. It would embolden the shorts, and it could set up a deeper correction. How deep? I don't know. Nobody knows. But corrections in silver can be brutal. We've seen moves of 30 to 50% in previous cycles. If you're not positioned for that possibility, you could get hurt. Now let me give you my perspective on how to think about this moment, because I want to leave you with something actionable. We're in one of those rare moments where everything is lined up for a major move. The fundamentals are supportive, the flows are unprecedented, the sentiment is intense, the catalysts are present. This is the kind of setup that creates generational opportunities. But it's also the kind of setup that creates generational traps. When everyone is piling in, when the headlines are everywhere, when the trade feels obvious, that's often the moment of maximum danger. The winners in this environment won't be the ones who perfectly time the top or the bottom. That's impossible. The winners will be the ones who manage risk, who size positions appropriately, who have plans and follow them, who don't let fear or greed make their decisions. If you're bullish on silver for long-term reasons, currency debasement, physical supply constraints, industrial demand, monetary policy, then short-term volatility shouldn't shake you out. But you need to be sized appropriately. You need to be able to hold through a 30% drawdown without panicking. If you can't do that, you're overexposed. If you're trading silver for short-term gains, you need to respect the volatility. You need to have stops. You need to be willing to take profits when you have them. And you need to accept that you will not catch every move. Some money will be left on the table. That's the cost of not blowing up. And if you're just watching, if you're not sure what to do, that's okay too. You don't have to be in every trade. You don't have to catch every move. Sometimes the best trade is no trade. Sometimes the smart move is to wait for clarity. But don't let waiting become paralysis. At some point, you need to make a decision. And if the conditions align with your thesis, you need to act. Now, let me wrap this up with a question I want you to answer in the comments. After everything I've shown you today, after the record flows, the unprecedented retail intensity, the political and monetary uncertainty, the physical supply tightness, the bears betting against the rally, after all of that, what do you think happens next? Are we heading for $150 silver? Are we heading for a crash back to 80? Are we going to chop sideways for months while the market figures out what's real? I genuinely want to know what you think. Drop a comment, share your perspective. Because this community is full of people who are paying attention, who are thinking about these issues seriously, and your insights matter. As always, keep your head, keep your standards, and don't let the crowd make your decisions for you. This is Mr. AG, Asian Guy. I'll see you in the next one. And one last thing. Everything I've shared here is for education and perspective. It's not personal financial advice. I don't know your situation, your timeline, or your risk tolerance. So don't treat this video like a custom plan. Use it as a starting point. Do your own research. Consult with professionals if you need to. And make the decision that's right for you. The silver market is making history right now. The question is whether you'll be part of that history or watching from the sidelines. Make your choice, and then own it. Let's go.